Imagine this. It's December 1994. Mexico is the darling of Wall Street, fresh off NAFTA. Foreign money pouring in, growth soaring at over 4% annually. Investors hail it as the Mexican miracle, a shining example of emerging market success. Billions flow in from abroad, fueling a stock market boom and real estate frenzy. Then, in the blink of an eye, the peso crashes 50% in mere days. Interest rates explode to 100%. Banks collapse under mountains of bad debt. Millions lose jobs overnight, plunging families into poverty. The contagion spreads like wildfire across Latin America and even hints at Asia. This is the tequila crisis, the financial implosion that shocked the world, nearly bankrupted an entire nation, and exposed the dark side of globalization. Grab a seat, because this is a roller coaster of political intrigue, economic missteps, investor panic, and a $50 billion bailout that changed the rules of international finance forever. We're diving deeper than ever, uncovering hidden scandals, personal stories, and the global ripples that still echo today. Let's rewind to the roots, back to the late 1980s. Mexico had just clawed its way out of the brutal lost decade of the 1980s debt crisis. Hyperinflation raged, peaking at 159% in 1987, eroding savings and crippling growth. Enter President Carlos Salinas de Gortari in 1988, a Harvard-educated economist. Salinas launches aggressive reforms. He slashes government spending, privatizes over 1,000 state-owned companies from airlines to telecoms, and opens the economy to foreign investment. Inflation tumbles to single digits by 1993. He negotiates NAFTA with the US and Canada, signed in December 1992 and effective January 1, 1994. The pitch: Mexico as a low-cost manufacturing hub, exporting cars, electronics, and textiles north. Wall Street buys in literally. Foreign direct investment surges to $30 billion by 1993, while portfolio flows, short-term hot money, hit $91 billion between 1990 and 1994. But beneath the miracle, cracks are forming. Mexico's current account deficit balloons to 7% of GDP by 1994, meaning they're re-importing far more than exporting, relying on foreign capital to plug the gap. The central bank, Banco de Mexico, maintains a semi-fixed exchange rate peg. The peso trades in a narrow band against the dollar, around 3 pesos per USD, to signal stability and attract investors. To defend this peg, they use foreign reserves dipping into dollars to buy pesos when pressure mounts. Reserves peak at $29 billion in early 1994, but start draining fast. Here's the sneaky part. To lure more capital without devaluing, the government issues Tesobono short-term bonds indexed to the dollar. Investors love them. They're risk-free since payouts are in dollars, not volatile pesos. By mid-1994, Tesobonos make up 55% of Mexico's short-term debt. But this is a ticking bomb. If the peso weakens, the government needs more pesos to buy dollars for repayments, straining the budget. Now, 1994 turns into a perfect storm of political chaos. January 1st, the Zapatista Army of National Liberation, EZLN, launches an uprising in Chiapas, protesting NAFTA's impact on indigenous farmers. Gunfire echoes. The army responds harshly. Investors jittery. Foreign capital outflows begin. March 23rd, Luis Donaldo Colosio, the ruling PRI party's presidential candidate and Salinas's heir apparent, is assassinated during a campaign rally in Tijuana. Conspiracy theories swirl. Was it drug cartels, internal rivals, or something deeper? The peso wobbles. Reserves drop further. Salinas appoints Ernesto Zedillo, another technocrat, as the new candidate. To shore up support ahead of the August election, the government ramps up spending, widening the fiscal deficit. Zedillo wins, but fraud allegations taint the vote. Another shock. September 28th, Price Secretary General José Francisco Ruiz Massieu is assassinated. Tensions boil. Capital flight accelerates. By November, reserves are down to $12 billion, half of what they were in February. U.S. interest rates rise under Fed Chair Alan Greenspan, making Mexican yields less attractive. Yet, officials downplay it all, assuring markets the peg is ironclad. Zedillo takes office December 1st, vowing no devaluation. But whispers in Washington and New York say otherwise. On December 19th, Zapatistas mobilize again, adding fuel. Then, the hammer drops. December 20th, 1994, in a closed-door meeting with business leaders, Finance Secretary Jaime Serra Puch announces a 15% widening of the peso band from 3.47 to about 4 pesos per dollar. It's meant as a controlled adjustment, but markets freak out. If they're adjusting now, what's next? Investors ask. Overnight, $4 billion flees. The next day, reserves hemorrhage another $1.5 billion. By December 22nd, the government abandons the peg entirely, letting the peso float. Chaos ensues. The peso freefalls from 3.4 to 5.5 per dollar in a week, eventually hitting 7.2 by March 1995, a 50% drop. Tesobonos repayments become a nightmare. The government scrambles for dollars. To stem the bleed, Banco de Mexico jacks up interest rates. Overnight rates peak at 120% in early 1995. Businesses that borrowed in dollars, common for cheap rates, now owe twice as much in pesos. Defaults skyrocket. Banks, already weak from earlier lending sprees, face a non-performing loan crisis. Bad debts hit 18% of portfolios by 1995. The human toll is devastating. Inflation surges to 52% in 1995, eroding wages. GDP contracts 6.2%, the worst recession since the 1930s. Unemployment officially doubles to 7.5%, but underemployment pushes real joblessness to 25%. Over 1 million jobs vanish in construction and manufacturing alone. In Mexico City, protests turn violent. Rioters clash with police over price hikes on tortillas and gasoline. Small businesses shutter. Suicides rise amid bankruptcies. One story: a Guadalajara factory owner, buried in dollar debt, loses everything: his plant, home, even family stability. It's not just elites. Rural farmers, already squeezed by NAFTA's cheap US imports, face ruin. The crisis spills over. The tequila effect. Argentina sees bond yields spike, forcing austerity. Brazil devalues its real in 1999 preemptively. Even Thailand in 1997 cites Mexico as a warning, though their crisis follows similar patterns. Global markets wobble. The Dow drops 2% on news. Enter the cavalry. The US, fearing a Mexican default could trigger migrant waves and trade collapse. Mexico is America's third largest partner, acts fast. President Bill Clinton, facing a GOP Congress hostile to bailouts, uses executive authority. He taps the Exchange Stabilization Fund for $20 billion, rallies the IMF for $17.8 billion, the World Bank and Inter-American Development Bank for $3 billion each, and Canada, plus others, for the rest, totaling $50 billion, the largest rescue package ever. Strings attached. Mexico pledges oil revenues as collateral, a humiliating nod to sovereignty concerns. Austerity bites hard as a Dio, cuts spending 20%, hikes VAT to 15%, privatizes more assets. Bank bailouts. Via FOBA-PROA, a new fund cost another $65 billion domestically, sparking scandals over crony rescues. Recovery. Surprisingly swift. The cheap peso boosts exports up 30% in 1995. Thanks to NAFTA, US factories shift south for lower costs. By 1996, growth rebounds 5.1%. Mexico repays the US early, in 1997, with interest proving critics wrong. But inequality widens. Poverty jumps from 45% to 69% of the population. The PRI's iron grip cracks a position, wins key governorships, and in 2000, Vicente Fox ends their 71-year rule. Lessons echo through time. Economists dub it a classic sudden stop crisis. Odd money inflows reverse abruptly. It highlights the impossible trinity. You can't have fixed exchange rates, free capital flows, and independent monetary policy simultaneously. Transparency fails. Mexico's hidden reserve drains fueled the panic. Bailouts breed moral hazard. Investors bet on rescues, encouraging riskier bets. This blueprint shapes responses to Asia 1997. IMF's harsh terms draw criticism. Russia 1998. Argentina 2001 default and depeg, and even echoes in Greece 2010. Fast forward. Today, Mexico's reserves top $200 billion. The peso floats freely, and a flexible credit line with the IMF acts as insurance. But vulnerabilities linger. Debt at 50% of GDP, reliance on US trade amid tariff talk. With global hot money still sloshing, think crypto flows or emerging market ETFs. The tequila crisis warns. Booms built on borrowed time often end in hangovers. Picture this as your own savings vanishing in a currency crash. Scary, right? If this deep dive hooked you, smash that like button, comment below. Was the bailout a lifeline, or a dangerous crutch? And subscribe for more epic tales of financial folly. The Mexican peso crisis wasn't just tequila, it was a shot that burned going down and left a lasting buzz. Stay sharp, question the miracles, and see you in the next crisis breakdown.